Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing a stock that was recommended by Rashawn Waymer. Sorry if I mispronounced your name. We pretty much just said, hey man, thanks for your videos. Can you give me your thoughts on the stock UMH? Now, I didn't even know what this stock was, but it is actually a REIT guys. So we are going to be analyzing the first REIT ever since updating the REIT evaluation calculator. So hopefully I get to do a pretty good job with this. I've tried this one a couple times before, but for some reason it's just very difficult to analyze REITs. So please bear with me. I'll try to do my best. If I miss anything, please leave it in the comment section below and I will update accordingly. But nonetheless guys, we're going to be analyzing this company based off of their fundamentals to see if maybe at the current share price it is a buy. So with that said, let's get started with this analysis. Coming into the dividend summary guys, this company does pay out a dividend like most REITs do. And by the way, before we actually move on with this, remember that REITs follow a different kind of tax law when it comes to dividends. Normally, dividends are taxed pretty efficiently when they're given out by like a normal company. However, REITs, because they're obligated to give out at least 90% or higher than 90% of all of their income in the form of a dividend, well, this means that they actually get taxed a little bit different and that you actually don't get that benefit that you do from like a company like Apple. So understand that when you do invest into REITs, you are getting taxed at full normal capital gains level. So now let's actually take a look at this dividend summary guys. Current dividend yield of 4.43%, which is up being 20 cents per share for an annual payout of 80 cents. Payout ratio of negative 195%. Guys, as a REIT, this really isn't telling us anything because again, REITs follow a completely different payout ratio system than all other companies. The 5-year CAGR on this dividend is only 1.87%, so it's rather small, and they've only have grown this dividend for one consecutive year. So let's come over here to the dividend history and see what we can actually find over here, because this might actually be a fluke. And we can see that it's not as bad as you would think, right? They have been very consistent, even on like the max guys. Look at this. Ever since what, 2008, they had a dividend of 18 cents. Now granted, they have been increasing it up until like 2007, 2008 because, well, that's when the recession happened. But ever since then guys, they did brought it down to 18 cents and they have at least kept it roughly the same at 18 cents for several years up until 2020, where then they actually increased it the following year of 2021 to 19 cents, and then in 2022 they increased it to around 20 cents. So it's not that they are bad with paying off the dividend, right? It's not sporadic. They're at least pretty consistent with it, so it's not too bad. However, you know, you would like a much more 5-year growth rate than at least 1.87%. Ex-dividend date guys passed as of August 12. Payout date is actually going to be on the 15th of September, so coming up. And of course, they pay their dividends quarterly. Now let us come over here guys to the calculator, the REIT evaluation calculator. And I really do hope that I can cover this pretty thoroughly because this is the first time. So again, if I miss anything, I'm terribly sorry. Please bear with me. We got the ticker symbol guys of UMH, market cap of $983.5 million. It's a rather small company. Current share price of $17.86. Now you're probably wondering, why isn't there a PE? Well, it actually turns out guys that essentially REITs don't have a PE, or at least it's not that they don't, it's just that it's not the best metric. A metric that we would actually prefer using instead of PE is actually something that we're going to cover later on in this video, but it has to do with this metric over here, and that is the current FFO, which is $29.1 million. And then following that, we also have current AFFO, which is at $0. So before we move on, let's actually cover these two concepts because they're rather new. So starting of course guys with FFO. What is funds from operations FFO? This is an article from Seeking Alpha. Funds from operations FFO is a measure of the amount of cash flow generated by a company's business operations. FFO is commonly used to evaluate the operating performance of a real estate investment trust, or REIT, a business that primarily operates income producing real property. Since a real estate company commonly uses FFO as a benchmark for performance, investors may also use FFO to evaluate a REIT equity investment before buying shares. FFO is a useful tool to evaluate performance of a REIT because it only includes items central to business operations and exclude non-cash items like depreciation and amortization, while also adjusting out gains and losses on property sales. Interest income is also removed in calculating FFO. So essentially, guys, FFO, it is their cash flow. Now, it's not as accurate as free cash flow, but it is still a pretty decent metric to look at. Now, we're actually going to take a look at, guys, one other metric, and that is net asset value. And that's going to give us a much broader representation of what the price should actually be. And of course, we're going to compare that to the metrics that actually have to do with FFO and AFFO. But now that we have covered FFO, let us cover now AFFO. And we get the exact same article, scrolling down, adjusted FFO, which is just AFFO. It is pretty much a related metric that considers a REIT's capital expenditures, CapEx. Considering CapEx adds another level of detail in terms of measuring actual cash flow as compared to FFO. The calculation of AFFO for a particular REIT may not be standardized, given some variability in defining the CapEx number. AFFO can effectively be used to better measure a REIT's ability to pay dividends from its net earnings. So again, this is just another way that we can essentially tell whether or not how much the company is making when it comes to their cash flow. It is essentially their capital expenditures. Just like for a normal company, we have cash from operations less your capital expenditures, that is the cash flow. In this case, we have the cash flow already based off of the FFO, and then when we subtract the capital expenditures, then we get the AFFO. Now you're probably wondering, why is it 0? We're going to take a look at the fundamentals in just one second, but nonetheless, that is 2 out of the 3 metrics that we're going to use to determine the value for this company. Now, as we just read, these prices, guys, are basically used as a way to determine whether or not the dividend is sustainable. So looking at this 80-cent per share annual dividend, this means that in accordance to the shares outstanding, they currently pay out $43.76 million in dividends every single year. And if we take a look at these payout ratios in regards to the FFO and the AFFO, we see that for the FFO, we have 150.38%, and unfortunately, well, we have 0 for the AFFO, for the current AFFO, and well, that essentially gives us, you can't divide by 0, so we don't really see that. However, what we do see is that FFO is at 150% as a payout ratio. Now remember when I said about dividends, when it comes to REITs, REITs follow different rules. They are forced to pay out minimum, I believe, 90% of all of their income in form of dividends. So this explains as to why we have 150% when it comes to the payout ratio when it comes to this REIT. And by the way, all REITs are pretty much the same. So that pretty much does it for all of this. Now coming over here, guys, to the fundamentals, we got the net income 5 years ago of $12.7 million to today, guys, of $17.8 million. That is an increase, guys, on the 5-year of 40% with a 5-year average, including today, of $13.05 million. So what we can see here from this graph is that, well, it's not as good as it could be. And then again, I really don't have a reference as to how these net incomes are supposed to look. But nonetheless, we can see that 4 years ago, guys, they did go negative to negative $36.2 million, and then 2 years ago during COVID they only did $5.1 million. So you can see it is very, very much all over the place. So basically, for this net income, I'm actually going to give it a score, guys, of like 20%. It is really, really bad. We did have a negative year when it came to 4 years ago, so after all, guys, it's just very, very bad overall when it comes to the net income. Now let's actually take a look at, guys, the FFO. We got 5 years ago of $23.5 million to today of $29.1 million. Guys, that is an increase of 24% with a 5-year average, including this year, guys, of 28.27%. So it's actually fairly good. And if we can actually take a look at this graph, you can see that it is trending upwards. It's not consistently trending upwards, but it is still fairly consistently. So for this, guys, I'm actually going to give it a fairly decent grade at around, like, I would say like a 60% or so, just because of the fact that it is still at least increasing year over year. Coming now into the AFFO, basically, guys, it is the FFO minus the capital expenditure, so it takes into account CapEx as well. And as you can see based on the graph, guys, it is pretty much the same thing as the FFO. So Yeah, I'm actually going to give it the same grade at around like a 60%. I'm going to assume that this missing value as of today, it is essentially a fluke, but nonetheless, I'm still going to give it, guys, a 60%. Coming now to the assets minus the liabilities, let us hope that their assets can cover the liabilities. And in this case, guys, they do. Currently, they're up to $521.9 million in this difference. You can see they have also increased this significantly throughout the years. Now, currently, guys, they are rather low as opposed to the 1 year ago number, but nonetheless, they can still cover it. And it's not a perfect score, but it's still fairly good when it comes to this metric. We got the average total assets at $1.1 billion. Average liabilities is $526.35 million, and doing this difference, we get $559.28 million. So basically, guys, I'm actually going to give this a fairly good grade at like a 75%, just because of the fact that we are still increasing it year over year, not consistently, but it is still increasing nonetheless. Coming now to the shares outstanding. Guys, this metric, unfortunately, when it comes to REITs, I find that they're actually always increasing it for some reason. But nonetheless, you want this value, guys, to be coming down, at least for normal companies. We have yet to see any other reference when it comes to this. So as it stands, guys, this is not looking good because they are increasing shares, therefore diluting you as the investor. We got 5 years ago of 35.5 million shares to today of 54.7 million shares. That is an increase of 54% on the 5 year, and it's just not good, guys. Even from the 1 year ago, they went up to today of 51.7 million to today, as I said, 54.7 million. I'm actually going to give this guy a really low score of essentially 0, because I mean, they have been increasing shares year over year. Well, actually, I'm actually going to give this a little bit higher. I would say like a 10%, because it could be a whole lot worse in my personal opinion. And when it comes to the total debt, guys, we can see that they currently have $876.6 million. And within the past 5 years, they have been increasing this at 125%. We can see that 5 years ago, they were at $389.6 million. And as I just said, today, they're $876 million. But you can see, aside from just this one outlier year, which is this year, they have been fairly consistent at around like the $500 million mark, but it's not like in the billions of dollars, as you could clearly see as we're getting closer as of today. So I'm actually going to give it, guys, like a 50% or so. Now let us actually take a look at the overall grades. We gave it net income of 20%, FFO 60%, AFFO 60%, assets minus liabilities 75%, shares outstanding 10%, and total debt at 10%, guys, for an overall grade of 46%. I wish I could tell you if this was a good grade or not. I have not done that many REITs when it comes to using this calculator, so unfortunately this 46% doesn't really tell me much of anything. I would like to analyze this company one more time after we do a bunch of other REITs, just so that way we see a better representation of how they actually work out. So now, with all of that said, guys, let's actually take a look at something called the net asset value, and this is essentially what's going to tell us how much the company should actually be worth. And it's a very simple calculation. It takes the assets minus the liabilities and then divides it by the current numbers of shares. That's about it. And that pretty much gives us the net asset value for the company. And as you can see right here, this company, guys, should be worth at $9.54. The current share price is $17.86. So based off of the net asset value, guys, it's pretty much just saying that we may need to wait for this thing to fall. However, let's do something else. Let's actually do now, guys, price divided by FFO. Remember when I said at the beginning of the video that REITs don't necessarily have a PE, but they have something similar and it uses FFO? This is what I'm talking about. It uses price divided by FFO, and this is pretty much giving us the PE. Now, if we do this math, guys, this is with the current FFO and the current share price, this is giving us a P divided by FFO of 33.8. What is this telling us? Absolutely nothing, right? We don't really have a reference as to what this actually is. So, guys, I actually did something else. I took the average 5-year price divided by FFO. So we took the current price and then divided that by the average FFO within the past 5 years, including today. And we get P over FFO of 34.79. So based off of this, based off of the price divided by FFO and the price divided by the average FFO, we can see that we are under by a little bit, by around 1 point on the price divided by FFO. So based off of that, guys, it's telling us that it might be a decent buy as well. And on top of that, if we do the same thing with the AFFO, obviously we don't really have a current AFFO, it's at 0, can't really do anything about that. But if we take a look at the average AFFO and do the price divided by the average AFFO, we can see that it is at 42.00. And again, the current one, it is at 33.8. Basically telling us that because it's below the 5-year average one, it might be a pretty decent buy even then, right? Because again, AFFO, it is a better accurate representation of what the price actually should be. So right then and there, guys, we have 3 different ways that we can analyze the true value of a company when it comes to a REIT. We got the net asset value, which is telling us that a decent price would be $9.54, and P divided by FFO, and P divided by the average FFO, and the P divided by the average AFFO pretty much is telling us that at the current share price of $17.86, it might be fairly decent. So unfortunately, when it comes to this, it doesn't really have any assumptions. But based off of that, guys, I still think that everybody should still have all of these calculators. In fact, I'm actually using your version right now because my version, I realize, doesn't have all the good stuff that you guys have. So yeah, I'm actually using the version that you guys have because it's way more developed than mine. So if you guys like it, guys, please have it. The link is in the description below to a video where all of them are there. You have the discounted free cash flow also on there, the book value, and this one right here, as well as a dividend tracking sheet for all of you guys to have. It's all for free. All I'm asking for in return, guys, is just help me grow my channel. Like, subscribe, comment, really does help. We are so close to 1,000 subscribers. I would love to get that by the end of September. That would be amazing. And you know, you guys get free daily content, free calculators, a dividend tracking sheet. All I'm asking for is just help me grow my channel, like, subscribe, comment, something free in return. Thank you so much for everybody who have already subscribed. I really do appreciate it. And if we can make it to 1,000, well, I do have a very special video planned out for then. So if you guys want to see it, make sure to hit that subscribe, and of course, tell me what you think in the comment section below. But now with all of that said, let's actually move into the dividends of this company. Let's say that you actually make the average monthly income of $5,725. If you were to buy 1 month's income of this company at the current share price, which in accordance to the net asset value is not a good price, but in accordance to the PFFO and the PAFFO average, it is. Well, if we do buy into it at the current price, we can see that we actually buy 320.56 shares, and the current annual dividends per share at 80 cents. This is a whopping annual dividends of $256.45, quarterly dividends of $64.11, and a monthly of $21.37. That is amazing, guys. That's a lot of money to be increased. Now remember, when it comes to REITs, you do get taxed differently. You are getting taxed full blown when it comes to this annual dividend. So that may be something good, that may be something bad, but nonetheless, you still get an increase of $256.45 annually. Not too shabby. All in all, guys, when it comes to UMH, honestly, not a bad company from what I've seen so far. However, this is the first company I am doing a reevaluation on using this calculator, so I really don't have a reference. I really don't. Hopefully I get to do a lot more. Hopefully some like American Towers or CCI or Realty Income, which I do plan on doing eventually. But nonetheless, it is the first one. If I missed a couple things or if I got a couple things wrong, please let me know in the comment section below. It is the first time I'm doing this, so thank you for being patient with me. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out and be on the lookout for the next stock analysis video.